Imagine a hurricane on the other side of the world impacting your savings account. It sounds unbelievable, but in today's interconnected world, disasters thousands of miles away can ripple through the global financial system and reach your wallet. The money you've worked hard to save is no longer insulated from the effects of climate change, no matter where you live. It's not far-fetched anymore. Climate change is rewriting the rules of money. Floods, wildfires, and rising sea levels are no longer just environmental issues, they're financial ones too. The stability of banks and the value of your savings are now tied to the health of the planet in ways we're only beginning to understand. For years, banks managed money, made loans, and kept the economy moving, separate from environmental concerns. Their focus was on profits, risk, and growth, rarely considering how their decisions might impact the environment or be affected by it. Now, the health of our planet is directly tied to the health of our financial system. Banks are being forced to recognize that environmental risks are financial risks, and ignoring them can have real consequences for everyone. The European Central Bank recently fined Crédit Agricole, a major French bank, not for a traditional banking error, but for failing to assess climate and environmental risks. This wasn't about a missing decimal or a bad loan. It was about not taking the planet's future seriously enough. This action sends a clear message. Ignoring climate change is a direct financial risk, and regulators are enforcing compliance. Banks can no longer afford to look the other way. The rules are changing, and so are the expectations. We'll break down what happened, why it matters, and how it affects you, not just as a banker, but as a saver and citizen. Whether you're managing a business or planning for your family's future, these changes will touch your life. Finance and the environment are no longer separate worlds. This fine is proof. The choices banks make about climate risk now shape the world we all live in. By the end, you'll see why a bank's climate policy is as important as its interest rates, and how these new rules are designed to protect us all, ensuring a safer, more sustainable future for our money and our planet. Let's meet the key players. First, the European Central Bank, the financial guardian of the Eurozone, setting and enforcing rules to keep banks safe and stable. Its job has grown. Now it supervises the biggest banks, making sure they don't take reckless risks. On the other side is Crédit Agricole, one of France's largest banks, with a global reach and a household name. As a major Eurozone bank, it's under the ECB's close watch. The ECB sets the standards. Banks like Crédit Agricole must comply. When the ECB finds a bank of this size, it's a public statement. The rules have teeth. This isn't just a bureaucratic dispute. It's a signal to the entire sector. The fact that this is about climate risk marks a turning point in financial supervision. Environmental concerns are now at the heart of banking regulation. So, what exactly is climate-related risk? It's a term you'll hear more and more in the world of finance, but what does it really mean for banks and the broader economy? Traditionally, banks worried about loan defaults or market crashes. Their focus was on credit risk, interest rates, and economic downturns. But now, they must also consider how environmental changes, like rising sea levels, extreme weather, and new regulations, threaten their bottom line and the stability of the financial system. There are two main types: physical risk, which includes hurricanes, floods, and wildfires that can damage assets, disrupt business, and cause borrowers to default. Then there's transition risk, which comes from the world shifting to a low-carbon economy as governments and markets push for cleaner energy and stricter environmental standards. If a bank lends to a business in a flood zone or invests heavily in coal just as the world moves to renewables, it faces real financial losses. These risks can hit suddenly or build up over time, affecting everything from property values to entire industries. Managing climate risk means banks must scrutinize their entire portfolio through this new lens. It's not just about individual loans, but about understanding how climate change could impact every part of their business. How many loans are exposed to climate disasters? How many clients are in industries facing decline? Are there hidden vulnerabilities in the bank's investments? Failing to answer these questions is now a serious financial oversight. Ignoring climate risk can lead to regulatory penalties, reputational damage, and unexpected losses. The ECB's action against Crédit Agricole shows regulators see climate blind spots as unacceptable. Financial authorities are making it clear, climate risk is a priority, not an afterthought. Climate risk isn't just an ethical issue, it's a core part of financial risk management. It's about protecting the bank's future and the stability of the entire financial system. Banks must adapt, rethink their strategies, and take climate risk seriously, or face serious consequences in a rapidly changing world. The ECB fined Crédit Agricole $755 million for failing to complete a materiality assessment, a process where banks identify which loans and investments are most exposed to climate risks. This isn't just paperwork, it's the foundation of responsible banking in a changing world. Without this assessment, a bank can't see where it's vulnerable or make informed decisions. Crédit Agricole's 75-day delay was seen as a serious breach, not a minor slip. The fine is less about the money and more about the message. Climate risk processes are mandatory. The ECB has moved from suggestions to strict enforcement. Every Eurozone bank is now on notice. Climate risk compliance is non-negotiable. This marks a new era in banking supervision. The rules are clear: assess, manage, and report climate risks, or pay the price. The Crédit Agricole fine is part of a global shift. Regulators everywhere are waking up to climate risk. The old days of voluntary green initiatives and glossy reports are over. Now, climate risk management is embedded in core banking rules. Banks must stress test their portfolios against climate disasters and show how they're managing these risks. This isn't just a European trend. The UK, Japan, and the US are following suit. Global regulators are coordinating, so banks can't hide from these new standards. Banks must invest in climate expertise, rethink lending, and shift capital towards sustainable sectors. The message is clear: adapt or face real financial penalties. The cost of ignoring climate risk is now immediate and substantial. This isn't just a story about big banks. Climate risk affects your savings, no matter how much you have in the bank. Whether you're saving for a rainy day, a new home, or your retirement, the impacts of climate change can reach your wallet in unexpected ways. Your bank uses your deposits to make loans and investments, helping to fund homes, businesses, and entire communities. But the safety of your money depends on the choices your bank makes. If your bank ignores climate risks, like floods, wildfires, or extreme weather, your money could be at stake, even if you live far from danger zones. Imagine a bank with lots of mortgages in a flood-prone area. If disaster strikes, the value of those homes drops, and the bank's losses can ripple out to affect all its customers. A major storm hits, homeowners default, and suddenly the bank and your savings are at risk. The effects can be long-lasting, impacting your ability to access your money or get loans. The same goes for your pension fund. If it's heavily invested in fossil fuels, the global shift to green energy could shrink your retirement nest egg, making your future less secure. That's why regulators are stepping in, forcing banks to assess and disclose these risks. Their goal is to protect your money and make the financial system safer for everyone. With more transparency, you can choose banks and investments that take climate seriously, giving you more control over where your money goes and how it's protected. These new rules help build a more resilient financial system for everyone, making sure banks are prepared for the challenges ahead. Responsible climate risk management isn't just good for the planet. It's essential for your financial security, your family's future, and the stability of our economy. The new rules are about protecting your future, so your savings can grow safely in a changing world. What happens when banks ignore climate risk? Real-world disasters show the consequences. In wildfire-prone areas, Insurers are raising premiums or pulling out. Homeowners without insurance may default, leaving banks with worthless assets. Property values drop, and banks face huge losses. In agriculture, a bank lending to a single crop farm in a drought-prone region risks massive defaults if climate patterns shift. These aren't future hypotheticals. They're happening now. Climate risk is a concrete financial threat, not just an ethical concern. Banks that ignore environmental dangers fail at their core job assessing risk. The ECB's fine is a wake-up call. Climate risk is as real as any market risk. These tougher rules aren't just about punishing banks. They're about building a safer financial system. By forcing banks to manage climate risks, regulators help prevent crises triggered by environmental disasters. Banks that understand climate risk make smarter decisions, shifting capital towards sustainable projects. This protects your money from being tied up in assets that could lose value as the world changes. It also funds the transition to a green economy, renewables, electric vehicles, and sustainable agriculture. The result? A win-win. Your savings are safer, and the planet benefits. Regulations like the ECB's align financial interests with environmental health. Climate risk is now priced into financial decisions, making the system more resilient. The market is finally working for both your wallet and the world. Why does an ECB fine against a French bank matter to you? Because it marks a turning point. Your financial future is now linked to climate action. The wall between finance and the environment is gone. As banks become more transparent, you can make informed choices about where to keep and invest your money. Ask your bank, how are you managing climate risk? Are you investing in solutions? Your choices send a powerful signal to the market. Aligning your money with your values is now practical and possible. Think about your savings and investments through this new lens of climate resilience. The definition of a safe investment is changing. Financial literacy now includes climate literacy. Managing money in the 21st century means managing climate risk for banks and for all of us.